I'm Steve Scott, Principal at Scott Investment Advisors. As part of our efforts to assist investors and investment professionals, we publish a series of insight videos like this one for your benefit. They're generally briefs or summaries from longer articles or research that we have produced in the past and are available for the asking. So please email us at asksam@ScottAdvisors.com. The subject today is risk management. Most view risk management in a very simple way, as a singular process. You take a company, you look at its product, you look at what it does, you look at how it does it, you look at the finances, and you drill down from top to bottom to the company. Or the other way is to look at the markets. A lot of people look at the markets in general without respect to different market segments and make decisions whether we're in a bull or bear market. We view things quite differently. First, we view risk management in a very comprehensive, all-encompassing manner to really allow risk management to work for you as hard as the markets will sometimes work against you. We believe investors, to the extent that they are trained and to the extent possible, should incorporate all the known factors for controlling risk in a single format that we call a good investment strategy. We made it easier for investors because we've formed several of those investment strategies around this principle. The first rule in the top 10 list really is to establish a realistic goal, a timeline to achieve those goals, and determine the best management policies with both the goals and the time horizon in mind, and use appropriate benchmarks or guideposts to measure the directional as well as the timeline progress. Number two is the quality of the portfolio from top to bottom. This can reduce volatility or risk. Higher quality generally results in a little lower return. Lower quality sometimes leads to very high returns, but high volatility or high risk. By being able to combine those two together is a way, again, number two way to control risk. An overlooked part of risk control is both the whole area of entry risk and exit risk. Entry risk when you first enter the markets. If you have bad timing and enter in March of 2000, you had a tough time for the next 18 to 24 months. If you put all your money in at that time, it was a great deal more challenging than had you systematically dollar cost averaged over a period of time, or bought bundles of very low-risk investments and gradually migrated them into a mature portfolio. The same thing can be said on the way out. If in fact you are reaching retirement period and you're looking to make distributions from a retirement fund, taking money out in a period of declining values can accelerate the decline of the overall portfolio. We think that is a manageable process that can reduce the overall erosion of the portfolio. The fourth way is to increase the number of portfolio holdings that you have. Buying a single stock subjects you to a great deal more systemic risk from holding that one than if you held several of the companies in the industry to which that was a part. Again, a way to control risk is broad diversification. A way to control the risk of being in the wrong sector at the wrong time. Picture being in financials and in energy sectors for the last 18 months. Or the technology sector in April or March of 2000. subject to a great deal of risk. So we like cross-sectional diversification across many different sectors. That's the fifth way to control risk. The sixth way is to the old cliche, don't put all your eggs in one basket. Simply means owning securities that all don't go up and down together. And with math today and the computing power that we have with programs, we can find assets that all don't go up and down together. In fact, we can find bundles that kind of offset or hedge against volatility in one sector, and well, it benefits the other. So that's the sixth way to control risk: non-correlated asset investments. Number 7 is intelligently organize a bundle of securities in an intelligent manner around a specific sector, or strategy developed for that goal and that timeline. In other words, to have utilize all those areas that we talked about, but have them organized to produce a certain return over a long-term period that's consistent with your objective. Once that is done, 2 additional methods that we like for controlling risk, 8 and 9, is think of it this way. Think of having a portfolio that you have built for an objective over a period of time, and the markets kind of carry one part of that portfolio versus another in a very different mix than you really intended. Rebalancing that is meaning you take those that have exceeded what you expected and rebalance them back to what the longer-term mix was intended to be. Much like fine-tuning your navigational direction, as if you were sailing from, let's say, San Francisco to Hawaii, and you got off course a little bit, you want to rebalance the combination of direction you were going, the speed you were going, and get back on course. The 9th area of risk control is the whole reallocation process. This might be equated, again, in that sailing exercise, is that the sails that you have up aren't exactly the ones that fit the weather. Let's say you need some bigger sails to capture lighter wind, or just the opposite, lighter sails or heavier sails and fewer of them to catch a sufficient amount of wind. But in very strong winds, you don't want your entire inventory of sails to be on the boat. That could break you down. Much can be said, same thing about a portfolio. Maybe there are industry sectors and securities that you should look to replace from time to time. Going back to the example of the energy and the financials and the technology at those various periods of time. That would be kind of reallocation time. Once all these 9 methods are utilized, we think that's a very intelligent way to run an investment strategy. And the final ingredient, much like a chef, if you've got the right material in place, you've got the right ingredients there, and it's getting prepared and cooked for the right period of time, being patient and let it work for you is the 10th ingredient to manage risk. Hopefully this was helpful to you, and we will visit you again with another subject on another day. Thank you very much for your time.